For almost 200 years, America built without asking permission from a bank. Not slowly, not primitively, not in chaos. Homes rose from timber and stone. Churches stood against brutal winters. Workshops turned raw wood into heirlooms that still refuse to wobble today. There were no national banking chains on every corner. No centralized credit score deciding who could build and who had to wait. And yet, entire cities took shape. So here's the question no one really asks. If America worked without banks for 2 centuries, what exactly changed in 1863? And more importantly, who benefited when it did? Imagine walking through an 18th century street at sunrise. The air smells like sawdust and iron. A master craftsman opens his workshop door. He doesn't check interest rates. He doesn't apply for financing. He doesn't calculate monthly payments. His wealth isn't stored in an account. It's stored in skill, reputation, and relationships. He learned his trade through apprenticeship, not a weekend certification, but years under someone who would stake their name on his competence. Pricing wasn't random. It wasn't a negotiation tactic designed to squeeze the desperate. It was measured, agreed upon, standardized inside local networks where cheating your neighbor meant destroying your future. Work could be exchanged for materials. Materials could be exchanged for food. Credit wasn't an algorithm. It was trust extended between people who would see each other again tomorrow. Money existed, yes, but it wasn't the bloodstream of every interaction. Communities regulated themselves. Builders coordinated without needing a distant institution to intermediate every transaction. When a meeting hall was needed, it was built. When a home was required, it rose. When a chair was crafted, it was made to outlive the craftsman. And that chair, the kind that survives 2 centuries without wobbling, tells you something quietly uncomfortable. Systems built on skill and accountability create objects designed to endure. But endurance isn't always profitable. Fast forward, February 1863. The country is in the middle of war. Pressure is everywhere. Resources are stretched, stability feels fragile. In the middle of that uncertainty, a new structure is formalized, a national banking framework designed to standardize currency and consolidate financial power. On paper, it promises order, uniformity, efficiency, and those are persuasive words, but embedded inside the new design is a powerful mechanism to expand currency. Banks must tie themselves to federal debt. To issue more money, they must purchase government bonds. Growth becomes inseparable from lending. Lending becomes inseparable from interest. Interest becomes inseparable from dependency. Slowly, not dramatically, not overnight, the center of gravity shifts. Before, wealth was primarily embedded in tangible skill and local exchange. After, wealth increasingly flows through institutions that stand between producer and product. At first, it looks like progress. Expansion accelerates. Industry scales. Railroads stretch across continents. Factories multiply. Production explodes. But scale changes relationships. When labor moves into industrial towns, wages replace apprenticeship as the dominant model. Instead of mastering a craft from beginning to end, a worker repeats one function on a line. Instead of negotiating directly within a guild, income is filtered through payroll. Instead of extended trust between neighbors, credit becomes formalized through contracts backed by enforcement. The shift is subtle but profound. When your income depends on wages, and your purchases depend on credit, and your housing depends on loans, your mobility changes. Leaving becomes harder. Risk becomes more dangerous. Independence becomes conditional. The language of progress grows louder. Efficiency, standardization, modernization. But compare the artifacts. An oak table from the early 1800s still holds steady, its joints tight without metal screws. A church framed before the banking consolidation still anchors its town square. Meanwhile, much of what is produced in the fully industrialized era is optimized for turnover, replaceable, disposable, designed for the next purchase. That's not accidental. It's structural. When profit depends on continuous transactions, durability becomes a threat. Now pause. This is not nostalgia for hardship. The old system had limitations. It was slower in some ways, fragmented in others. Local currencies could be inconsistent. Communication wasn't instant. Expansion was gradual. But here's the deeper question. Was centralization the only possible evolution? Or was it the most scalable for those positioned at the center? Because once banking becomes nationalized, the economy begins to orbit it. Large projects require loans. Expansion requires credit. Survival during downturns requires access to capital. Those without access fall behind. The psychological shift might be the most significant of all. Before consolidation, identity is tied closely to community and craft. After consolidation, identity is increasingly documented, categorized, and monetized. You become a borrower, a wage earner, a data point in a system that tracks productivity and creditworthiness. Opportunity expands, yes, but so does dependence, and dependence changes behavior. When your house is financed, your land mortgaged, your tools purchased on credit, and your consumption normalized through revolving debt, stability becomes linked to continuous participation. Stepping away isn't simple. Opting out isn't neutral. It's risky. So when people say 1863 changed everything, they don't mean buildings stopped rising. They don't mean innovation disappeared. They mean the foundation beneath the economy shifted from decentralized skill networks to centralized financial architecture. From contribution-based exchange to interest-based expansion. From local trust to institutional oversight. And here's the unsettling part. Once a society reorganizes around debt and centralized currency, reversing that structure becomes almost impossible. Because the system sustains itself. Growth requires lending. Lending requires borrowing. Borrowing requires future labor pledged forward. The machine feeds on continuity. Now look again at that old chair in the corner of a quiet room. It wasn't built for quarterly earnings. It wasn't optimized for recurring purchase cycles. It was built by someone whose reputation lived in the object itself. It still stands. And as you look at modern economy, the speed, the scale, the volatility, the convenience, the fragility, you have to ask, did central banking create stability, or did it create a different kind of risk? Did we gain efficiency at the cost of independence? Was 1863 the birth of financial order, or the moment America quietly rewired itself around permanent debt? There's no dramatic villain in this story. No secret meeting in a candlelit room. Just structural incentives, war pressures, expansion demands, and decisions that compound over time. But patterns matter. Before 1863, growth could occur without a nationalized financial backbone. After 1863, large-scale growth becomes inseparable from it. Before, credit was relational. After, it was institutional. Before, durability was common. After, replacement became normal. Progress is real. Innovation is real. Comfort is real. So is dependency. And once you notice the shift, you can't unsee it. America worked without centralized banking for 200 years. Then 1863 changed everything. The buildings still stand. The question is, what kind of foundation are we standing on now?